Hey everybody, good morning. It's Pete. Welcome. It is Monday, May 4th, 2020. Welcome to today's episode of Stocks for Breakfast. Uh, Interesting day setting up in the market. As if the global pandemic wasn't enough, we have something else to deal with on the East Coast of the United States. I'm going to show it to you very quickly. You're not going to believe what you see if you haven't heard about it. This picture is just crazy. I mean, are you kidding me? Now we have to deal with giant murder hornets on the East Coast. Look at that thing. They're saying that they're 2 inches in size. That's absolutely crazy. On top of everything else we're dealing with right now. I got a lot of good questions over the weekend. Before we actually get into the questions, I'm gonna share the screen and get into them. I get some very interesting emails. You wouldn't believe some of the stuff that people take their time out to write to me. The first one I want to address was somebody actually complaining about the simplicity of what I talk about and how I go about reading the market. For some reason, people have this belief that trading needs to be more complicated and your screen needs to look like you work at NASA and you could have a radar on there or something. I don't know why. I mean, I understand a little bit why. When I first started trading back in April of 2000, I thought I needed more on my screen to make better decisions, and it just goes into this loop where you're constantly looking for more. You're constantly looking for the next indicator that would be the salvation for if you happen to not be profitable right now, and it'll get you to the point where like you need that one more thing, and once you find that one more thing, you'll get profitable. And in sync with that is actually the belief that as a trader, you always feel like you're one piece of advice away from being successful. So in other words, you know everything about what you're looking at, but you just can't make money yet. And that's actually one of the questions that we're going to address right now. So anyway, I'm going to get right into that stuff. I don't want to get too far off track, but there's actually a couple of stories that I want to get into, and then we're going to get straight into the charts. But one thing the first story I want to get across is somebody asking a question about if my stocks are all above the key moving averages that somebody would normally watch. In my case, and when I do have the moving averages on my screen, I look at the 20, the 50, and the 200. And if you know, most of my stuff is based on Dow theory and pure tape reading principles. So Dow theory says that you have the short-term fluctuations back and forth, then you have the intermediate term and the long-term bull bear market. Here's the question: if the last price is above all of the moving averages, can I blindly assume I should just be a buyer? The answer is hell no. No. And that's the difference between somebody who's a chart reader struggling and can't get to the next stage and always and never feeling confident, from somebody who realizes that if I'm going to be a trader and actually pull money out of the market, I have to set up trades. Is so much more than just reading an indicator or having a scan or having a trading alert to determining whether or not you should actually allocate money, put your money in harm's way because you believe that the risk justifies the reward. So I'm just going to use one chart, maybe two charts as an example, just to give you some context. Also, to really illustrate the point about why you see in my charts, for the person that complained I keep things too simple, which I think is funny, why I don't do my game planning with any moving averages. My game plan mostly focuses around, I do my scans first, but then I take the stocks that seem interesting or could be a play based on just the fact that they met certain criteria. Then you have to go into the charts and dig in and see if there's actually a trade there. And I think that separation is where a lot of traders miss the boat. And actually, they never become a trader. They're just chart readers. Like, the charts will give me money. No, the charts aren't going to give you money. The charts will give you ideas. The charts don't give you money. You still have to learn how to pull money out of the market. And that's why you'll see on my charts when I'm looking at the market and I'm setting up ideas, I'm using the daily charts and I'm usually pulling out 3 to 6 months with no indicators. And I'm looking for whether or not there's actually something going on. And I'm going to address that in one of the questions coming up. And I think it's going to be pretty interesting. We're going to touch on some news to start out. And then, actually, you know what? We're going to go into that example first. So let me share the screen. And here's the actual example. So you can see Microsoft, and it has all the major moving averages that somebody might normally move. The 20-period moving average is going up. The 50-period moving average is going down. And the 200 is actually slowly trending higher. But does that mean that the stock is an absolute buy? It's a no-brainer buy? No. And here's why. And this is actually why I'm looking at this, most of the stocks that I look at without moving averages when I do my game planning. The stock is basically stuck for 2 weeks. Now, yes, we had earnings last week, and it's affecting the stock. We actually broke out and then pulled back a little bit. But right now, the stock is essentially trading between 170 and 177.50. So the fact that the moving averages are not all pointing in the same direction, which is one thing, although they are in the right order, the 20s above the 50 and the 50s above the 200, right? If you know classic moving averages, that is the right order. But you don't blindly look for a trade here. There's nothing to do. Now, you could make a case for the fact that the stock's pulled back for a couple of days. Maybe you're looking for a strong stock to bounce, but that's the right price right now. Let's take a look at another one. BBY, very similar, right? Price is at 200-period moving average is flat, the 50-period moving average is going down, and the 20-period moving average is going up. But prior to Friday, it was actually above all of the key moving averages. Does that mean that it's a blind buy? No. It doesn't. You still need to put the pieces together to how far did it just travel? Where is the room to go? What is it doing the last couple of days? I'm going to use the SPY and the Q as one more example, two more examples. So you can see that we're very mixed here, which actually brings me to the next question. I want to get into a question here that was asked by Jay Carter. By the way, absolutely leave questions. I might not get to them exactly the next day, but absolutely leave questions. My biggest challenge is that I work full-time, 8 to 5, Monday to Friday, so I'm not always able to get in on a trade when I want. So my biggest problem is timing, is getting the timing right. This is particularly the case for day trading, so I've come to the conclusion that swing trading is better suited for me when entering and monitoring and exiting trades. There's a little bit more to the question, but I just want to get into that first. If you have another full-time job and you happen to be working home right now, first I want to address the current market, and then I want to address day trading versus swing trading. The current market, the last, let's say the last 3 weeks especially, just to give you an example, Goldman Sachs has gapped 5 times in the last 5 days. Now, I'm not just talking, again, for the technical definition of a gap. It means it's not a higher opening or a lower opening. So get that, let's get that definition clear so that we're on the same page. A gap means it opens outside of the previous day's trading range. Now, it's not just a higher or lower opening. It means it literally opened outside of yesterday's higher low to the upside of the downside. Goldman Sachs has gapped 5 times in the previous 5 days. That's a lot. That's not normal. At some point, you would expect the stock to open flat and at least within inside the previous day's range. The S&P 500 or the SPY has basically had melted candles other than one big day of selling, which I believe was last Tuesday or whatever day it was. You know what, I'll go to the charts this way, they're on the charts. So when I talk about melted candlesticks, let me actually take these guys off the screen so we could do exactly the way I normally talk about it. The S&P 500 has pretty much been traded. Yes, it's definitely going higher. Look at all these melted candles, opening and closing basically in the same spot. Goldman Sachs, 5 gaps, 1, 2, 3, 4, 5 gaps, and a bunch of melted candles, and pretty much sideways. So Jay, here's the point that I want to make and just address it to everybody. Number one is this recently, the last 3 weeks, despite what you're reading about where the market's going and how awesome it was in April, yes, for long-term investors, the market had a tremendous rally off of the March lows and had a tremendous April from a performance perspective coming off the lows. from an active trading perspective. So let's start out with swing trading and then we'll delve into day trading. We have our chat room every day where we have the Slack community and there's people joining the boot camp on a regular basis, and new people are coming in. And some of the first emails that I get were, I was expecting it to be a lot more active. So in other words, they have this vision of what day trading is supposed to be versus what good day trading actually is. Good day trading means that you're recognizing the criteria of whether or not you should be active, where stocks have opportunity, where stocks have volatility, and good ideas. All three of those things, not just one, not just two, but all three. And the market has been challenging. We've had these gaps that have been sucking all the intraday volatility out of the market, where basically we've been gapping, going sideways, and then having moves that have been starting at lunchtime, which is unusual also. Earnings have been coming out and giving some volatility against previous moves. So the point that I'm trying to make here is day trading recently, specifically day trading, then we'll get into Jay's question about timing and trading full time right now. I don't know you, Jay. I've never met you before, and I'm giving general advice. But for those people that are now day trading who have another full-time job, it's very difficult to do, even if you're not stuck working from home and just decide that you want to day trade. Doing something else full time and trying to day trade while you're working is incredibly difficult. Day trading by itself is challenging, but doing both at the same time is also challenging. Doing it in this current environment is super challenging. We'll talk about in a second. The stock market now. We're about to pick a fight with China. Now we're apparently getting back to where we're picking another enemy. And again, I'm not making this political or anything like that, but it's reflecting on the market where there's a lot of indecision going on right now. And I have to put a disclaimer out. If you're not a full-time day trader and it's not what you do for a living, this is not the market to try and become one. That's the best way to do it. But let's talk about even the second way to do it. The second piece of wisdom. I don't want to call it advice because I don't want to say I'm giving advice or tips or anything like that. The second piece of experience that I have right now is, if you have another full-time job, don't day trade. Don't day trade. Swing trade. Look for opportunities where you're looking at stocks that are well bid or well offered. Let's just stick to the buy side and kind of helping to answer the question for Jay. Have buy stops outside of the previous day's market. So in other words, most buy stops, if you want to get long, you're looking at a stock that closed strong, you're looking at a stock that's now trading above the previous day's high, and you're looking for follow through. That's the simplest way to get your timing down. If you how do I want to word this? If the next problem that you have, which actually I had another question about, how do I know when to book profits? The next thing that you need to know is, how much does a stock normally move? And again, we look at it on the chart to the left and we say, how much does the stock move the last time it had a bullish run? So if you want to be a buyer, look to the left. And again, I'm going to get comments about how simple this is, but we're looking at price action itself to tell us where it normally does. That's what we're supposed to do. We don't need to make it complicated. If now, Jay, you're in a trade and you get your entry price, look to the left and say, if a stock normally moves $15, this particular stock normally moves $15 during a bullish run, that's what you should be projecting as your profit target. That's literally telling you what it normally does. But you need to know now, did you buy after the stock turned around and it's already gone 8 and it has maybe that last 7 left? Then you have to say, what's the risk that I'm willing to take in order to make that next 7? If you have to risk 4 to make 7, that's not worth it. That's actually a negative, well, it's not a negative risk reward, but hardly one that's worth taking overnight risk. So I guess the point that I want to get across here is, it's kind of like a public service announcement for day trading. If you're working another full-time job, I'm just going to flat out say it, don't do it. I'm sorry, don't do it. The other part is that the market has been tough. Virtually every full-time trader that I know right now is pulling back their volume in a big way. because there's been pockets of opportunity where you've had to really be focused and only trade the best ideas. And that's smart because, again, reality, if you've never traded full time, the majority of what you make comes from about 40% of your total trades. That's just reality. Now, don't hit me with the bullshit about I have a 90% win-loss ratio. I could throw that out the window in 1 second. 1 second. 90% win-loss ratio, one dumb trade can wipe out the other 9. It's not about your win-loss ratio. Sure, that sounds great. It sounds awesome when you're at a barbecue and you can talk to somebody about that. It's about consistency, and it's about making the most you can out of great situations, because most of the time it's not perfect. You have to decide on how to adjust your share size up and down. You have to decide on how to adjust your risk up and down and commensurate with the volatility and the quality of the idea. Every trade, if we're going to really take it to the nth level and talk about discipline, every trade is not a perfect trade unless you're only taking perfect trades, which most people don't. Most people don't take anything even close to a perfect trade. So the point is, if you really want to do this for a living, if you really want to do this full time, whether you're swing trading or day trading, it really comes down to you need to recognize the market conditions and you have to trade accordingly. And yes, the move down was really good from a day trading and active trading perspective. The bounce off the lows for about 3 weeks was really good. Now we've been sideways for almost a month. Since March 13th, the market has pretty much been sideways. So we're talking about 3 or 4 weeks of indecision. If you believe that you've had a hard time making money in that particular market and you want to know what you're doing wrong, there's 2 things. Number one is, if you didn't recognize the fact that the market was going sideways and it was really so much more super stock specific, that means you don't have an edge yet. So there's actually another question that was asked that said, I can't find any great opportunities with the current market conditions. That's awesome. I've said that in the past. I absolutely love to hear when somebody says that. Not because you can't find opportunity, but because that means that you actually have a strategy that tells you that what you're looking for is not there. So that's the point that you really want to get to. If you believe that every single day you go into the market and no matter what, you could find something to do, maybe you can, but that doesn't mean they're all great ideas. So keep that in mind. So I guess this is kind of like, I'm kind of like making a stocks for breakfast today to help everybody be aware that the image of what it means to trade actively, whether it's a day trader or a full-time trader, is not what it was back in 2000. Where, and I know that's, gosh, it sounds so long ago. It's not what, it's not the fantasized vision of what it means to be a full-time active trader. The best traders keep it simple and they wait for it to look obvious. The traders that struggle and never get paid, and I'll go back to the very beginning of the video, that always feel like they're one thing away. Well, the one thing that they're missing is discipline. The one thing that they're missing is discipline following a strategy. But that means that you need to take the time to say, this is exactly what I'm looking for. And unless I see that, I'm not doing anything. And that's really it. I mean, there's no other way to put it. I'm kind of emphasizing this today because of the amount of emails I got from Friday through the weekend. And also some posts. I feel what you're saying because I went through it, and it really comes down to this. You need a strategy, and you need to determine, are you doing this full-time or not? And if you're not doing this full-time, you're not in the market every day, it can be tough for you to feel what's going on in the market. If you are doing it full-time every day, you need a strategy to tell you, I'm not doing this, or I am getting involved more. I know I'm going to get some more emails about this. I know I'm going to get some more comments, but the bottom line is, if you want to take this seriously, there's going to be periods where you have to say, I can't wait to step on the gas right now because everything's obvious. And then there's going to be other periods of time where you're going to be sending me emails saying, what am I missing? Why can't I find something to do? And I'm going to say, I'm with you because it's kind of choppy right now. So I guess that's really what I wanted to get across, is that the difference between part-time trading and full-time trading is a huge gap. It's so much bigger, and I talk about it all the time. It's the difference between baseball and softball. They look like the same game. They're not. Day trading and swing trading, absolutely not the same business. But if you do decide to take that leap where you're doing this full time, take it to don't risk too much money until you don't risk any money. Quite honestly, don't risk any money until you actually get to the point where you say, "This is exactly what I'm looking for every day, and unless I see this, I'm not making a trade." Only then should you get involved in the market and start to risk capital. And I'm going to give you one more caveat. Regardless of how much experience you have right now, if you decide to do this full time, I can 100% guarantee you it's going to take longer than you expect, especially if you're trying to do it on your own. If you join a coaching program like mine, we can absolutely get you there faster. Not even a question. I've done it too many times for anybody to dispute that. But it will take longer than you expect. It will challenge every part of you because of something that somebody else said, gaps, algorithms, market feels like it's whipping all over the place. You need to recognize that to pull yourself back so that you still have money left when it actually picks a direction. So I don't want to drag this video out any longer with the same type of comment, because I literally have a bunch of emails basically along those same lines. So here's really what it comes down to. If you're working another job, don't day trade. Don't day trade while you're working your other job. It's just not a smart thing to do. If you do decide to do this, get educated, get coaching, and it's going to take a little bit longer than you expected it to, but make a decision. If you're going to day trade, how are you going to day trade? Are you going to do nothing but run scans all day and look for opportunities, or are you going to trade one or two patterns and just trade a small bunch of stocks? Obviously, that second part, the second suggestion there is the way I think is the easiest way to learn how to make money is grab a group of stocks that you feel comfortable trading, look for only one or two patterns, and just trade the heck out of them, and that's where you'll find the most consistency. So anyway, this is it's kind of a Monday morning thing. I was trying to think about how I can encapsulate the angst that I heard in a lot of the emails that I got over the weekend, and it really comes down to be focused, be disciplined, and don't day trade if you have another full-time job. It's incredibly, incredibly difficult. I'm sure there's one or two people that are going to email me and say, I'm doing it. Fine, you're the exception. You're not the rule. So anyway, let's hope everybody's being safe. If you like these kind of videos, absolutely click down and subscribe, and I'll speak to you soon.